You just co-signed a $20,000 loan to help a family member. You didn't just share your good credit, you bought their contract risk, and one late payment will tank your score. Most people use the words joint, co-signer, and authorized user like they mean the same thing. The lender doesn't, the bureaus don't, and when something goes sideways, the gap between those three labels is the difference between losing 30 points and losing your mortgage approval. Here's exactly what each one actually does to your file. This is Optimized Credit, where we teach how credit actually works. Every shared account creates two completely different kinds of risk, and people only think about one of them. The first is reporting risk, whether the account helps or hurts your score. The second is contract risk, whether the lender can legally come after you when the money runs out. Most people sign up chasing the reporting benefit and never realize they handed over their legal liability in the same signature. Let's start with the heaviest version. A joint account means two people share full ownership, full access, and full legal liability. You both signed, you both can spend, you both owe every dollar on that balance, no matter who actually swiped the card. There is no "that was really their charge" defense. The creditor does not care. A joint account never splits down the middle on your credit report. The entire debt shows up in full on both files. If the card has a $10,000 limit and a $9,000 balance, your personal utilization reads like you just maxed out a card, even if you never touch the plastic. If your partner misses one payment, you both eat the same 80 to 100-point drop. Same balance, same history, same damage. Co-signing looks similar. It is not. When you co-sign, one person is the primary borrower. They drive the car. They live in the apartment. They spend the loan. You just lent them your credit profile so they could qualify. But the lender treats you as fully responsible for every dollar. You usually don't control the account. You may not even know a payment is late until your score drops 90 points overnight. That is the cruelest structure in personal finance. Maximum exposure, minimum control. And it gets worse. That co-signed loan also lands on your debt-to-income ratio. So if you co-sign a $40,000 auto loan for your son and apply for your own mortgage 6 months later, the underwriter counts that $40,000 against your borrowing power. You can be denied a house because of a loan you have never made a payment on. Authorized user status is the opposite mechanism. The primary cardholder owns the account. They are the only one legally on the hook. You get a card with your name on it. You can spend on it, but if the balance goes unpaid, the creditor cannot legally come after you. You never signed the contract. Here's why authorized user status matters. If the issuer reports authorized users to the bureaus, that whole account flows onto your credit file: the age, the limit, the payment history, the utilization. A parent with a 12-year-old card at 2% utilization can add their kid as an authorized user, and that kid borrows the entire history overnight. Reporting reward, zero contract risk. That is why authorized user is the safest first move for a thin file or a young adult. But understand the asymmetry. You ride the primary's behavior. If they max out the card next month, your utilization spikes. If they miss a payment, that late mark can land on your file too. You have an easy exit. One phone call removes you, but until that call, their mistakes are your mistakes. If you want a free personalized 30-day action plan built from your actual credit report, head to optimizedcredit.net. Here's where divorce destroys people who didn't read their own paperwork. A divorce decree can say your ex is responsible for the joint visa. Your lawyer signs off, the judge signs the order. None of that touches the lender's contract. The bank was not in that courtroom. The bank does not answer to family court. So your ex stops paying in month 7. The card goes 30 days late, then 60, then 90. Every one of those marks reports to your file too, because your name is still on the original contract. You can sue your ex for breach of the divorce agreement, but by the time that resolves, your score has dropped 150 points, and you've been denied 2 refinances. Family court allocation is not the same thing as lender release. The only way out of a joint account is to pay it off and close it, refinance one party off if they now qualify, or get the lender to formally restructure the contract. A divorce decree by itself does nothing to the lender. Cosigners face the same trap with one extra cruelty. You usually cannot pay the loan off to escape. The primary borrower controls the account. Your only real exits are full payoff, refinance into their name alone if they now qualify, or a formal cosigner release program if the lender offers one. Most lenders do not. Until the lender releases you in writing, that debt counts against your file every time another bank pulls it. Authorized users get the cleanest exit on the menu. One phone call to the issuer and you're off. The account stops reporting to your file in the next billing cycle. Whatever score support it was providing disappears, but so does every ounce of future risk from that primary cardholder's behavior. Easy on, easy off, that is the entire authorized user advantage. Here's the test you should run today. Pull all 3 of your credit reports from annualcreditreport.com. Find every shared account. Look at how each one is coded. The Bureau labels it explicitly as joint, individual, authorized user, or cosigner. Then call the lender and confirm in writing. Do not trust your spouse, your parent, or your adult child's memory of how the account was opened. Household shorthand like "we're both on it" describes 3 completely different legal structures, and you do not want to find out which one when you are already in trouble. When you actually know the structure, the strategy gets simple. Authorized user is the right tool for credit building. Low legal risk, strong score support, easy exit. Co-signing is only for the narrow case where you have decided you are personally ready to make every payment yourself if the primary fails. Joint is for 2 people running one genuinely merged household where every dollar in and out is already shared. Mismatch the structure to the situation, and you get the worst of both worlds. A parent who opens a joint card with a college kid is 1 missed payment from a 100-point drop. A spouse who co-signs a car loan and then divorces is stuck with the debt until that car is sold or refinanced. An authorized user who never asks to be removed after a breakup keeps absorbing the primary's mistakes for years. The question to ask before you sign anything is not, "Will this help my score?" It is this: if this debt goes unpaid tomorrow, who can the lender legally come after? If the answer includes you, you are either joint or a co-signer, and your exit will require paperwork, not goodwill. If the answer does not include you, you are an authorized user, and you can walk away whenever you want. Convenient isn't always safe, and shared isn't always equal. Figure out exactly which structure you signed, what kind of risk you actually own, and whether the upside is worth the legal weight you are carrying. Understanding these foundational rules is only step 1. To map out your exact next moves, run a free profile scan and get your 30-day action plan at optimizecredit.net. And make sure to subscribe for more step-by-step credit education.